Today we'll hear testimony from the Honorable Michael S. Barr, Vice Chair of Supervision of the Federal Reserve Board of Governors, the Honorable Martin J. Grunberg, Chairman of the Board of Directors of the Federal Deposit Insurance Corporation, and the Honorable Nellie Lang, Undersecretary for Domestic Finance of the U.S. Department of Treasury. We thank each of you for your time, and we're going to be recognized for 5 minutes for an oral presentation of your written testimony. We'll begin with you, Mr. Barr.
Chairman McHenry, Ranking Member Waters, and other members of the committee, thank you for the opportunity to testify today on the Federal Reserve's supervisory and regulatory oversight of Silicon Valley Bank. Our banking system is sound and resilient, with strong capital and liquidity. The Federal Reserve, working with the Treasury Department and FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that we are committed to ensuring that all deposits are safe. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as necessary.
If the gentleman will dispense for a second. Mr. Foster, you'll turn off your mic. Thank you. We'll let you continue. Thank you.
Shall I proceed?
Oh, all right. Go ahead. If everybody will check your mics and make sure you're off. Did you just do that to Mr. Torres? All right. See, we can even have a sense of humor in the midst of serious stuff. We'll let you continue. Thank you, Vice Chair Barr.
Thank you, Mr. Chair. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools for any size institution as needed to keep the system safe and sound. At the same time, the events of the last few weeks raise questions about what more can be done and should be done so that isolated banking problems do not undermine confidence in healthy banks and threaten the stability of the banking system as a whole. At the forefront of my mind is the importance of maintaining the strength and diversity of banks of all sizes that serve communities across the country. SVB failed because the bank's management did not effectively manage its interest rate and liquidity risk, and the bank then suffered a devastating and unexpected run by its uninsured depositors in a period of less than 24 hours. Immediately following SVB's failure, Chair Powell and I agreed that I should oversee a review of the circumstances leading up to SVB's failure. In this review, we are looking at SVB's growth and management, our own supervisory engagement with the bank, and the regulatory requirements that applied to the bank. The picture that has emerged thus far shows SVB had inadequate risk management and internal controls that struggled to keep pace with the growth of the bank. Supervisors began delivering supervisory warnings near the end of 2021. Our review will consider whether these supervisory warnings were sufficient and whether supervisors had sufficient tools to escalate them. We are also focusing on whether the Federal Reserve's supervision was appropriate for the rapid growth and vulnerabilities of the bank. While the Federal Reserve framework focuses on size thresholds, size is not always a good proxy for risk, particularly when a bank has a non-traditional business model. Turning to regulation, we are evaluating whether application of more stringent standards would have prompted the bank to better manage the risk that led to its failure. We are also assessing whether SVB would have had higher levels of capital and liquidity under higher standards, and whether such higher levels of capital and liquidity could have forestalled the bank's failure or provided further resilience to the bank. We need to move forward with our work to improve the resilience of the banking system, including the Basel III Endgame reforms, a long-term debt requirement for large banks, and enhancements to stress testing with multiple scenarios so that it captures a wider range of risk and uncovers channels for contagion, like those we saw in the recent series of events. We must also explore changes to our liquidity rules and other reforms to improve the resiliency of the financial system. In addition, recent events have shown that we must evolve our understanding of banking in light of changing technologies and emerging risks. Part of the Federal Reserve's core mission is to promote the safety and soundness of the banks we supervise, as well as the stability of the financial system, to help ensure that the system supports a healthy economy for U.S. households, businesses, and communities. Deeply interrogating SVB's failure and probing its broader implications is critical to our responsibility for upholding that mission. Thank you, and I look forward to your questions.
We'll now recognize Chairman Gruenberg.
Thank you, Mr. Chairman. Chairman McHenry, Ranking Member Waters, and members of the committee, thank you very much for the opportunity to appear before you today to address the federal regulators' response to the recent bank failures. On March 10th, just over 2 weeks ago, Silicon Valley Bank, or SVB as it's known, with $209 billion in assets at year-end 2022, was closed by the California Department of Financial Protection and Innovation, which then appointed the FDIC as receiver. The failure of SVB, following the March 8th announcement by Silvergate Bank that it would voluntarily liquidate, signaled the possibility of a contagion effect on other banks. On Sunday, March 12th, just 2 days after the failure of SVB, another institution, Signature Bank of New York, with $110 billion in assets at year-end 2022, was closed by the New York State Department of Financial Services, which also appointed the FDIC as receiver. With other institutions experiencing stress, serious concerns arose about a broader economic spillover from these failures. After careful analysis and deliberation, the boards of the FDIC and the Federal Reserve voted unanimously to recommend, and the Treasury Secretary, in consultation with the President, determined that the FDIC could use emergency systemic risk authorities under the Federal Deposit Insurance Act to fully protect all depositors in winding down SVB and Signature Bank. It's worth noting that these two institutions were allowed to fail. Shareholders lost their investment, unsecured creditors took losses, the boards and the most senior executives were removed. The FDIC has authority to investigate and hold accountable the directors and officers of the banks for the losses they caused to the banks and for any misconduct in the management of the banks, and the FDIC has already commenced those investigations. Further, any losses to the FDIC's deposit insurance fund as a result of uninsured deposit insurance coverage will be repaid by a special assessment on banks as required by law. The FDIC has now completed the sale of both bridge banks to acquiring institutions. My written testimony today describes the events leading up to the failures of SVB and Signature Bank and the facts and circumstances that prompted the decision to utilize the authority in the Federal Deposit Insurance Act to protect all depositors in those banks following those failures. It further describes the management and disposition of the bridge institutions that were established. It also discusses the FDIC's assessment of the current state of the U.S. financial system, which remains sound despite these events. And in addition, it shares some preliminary lessons learned as we look back on the immediate aftermath of this episode. In that regard, the FDIC will undertake a comprehensive review of the deposit insurance system and will release a report by May 1 that will include policy options for consideration related to deposit insurance coverage levels, excess deposit insurance, and the implications for risk-based pricing and deposit insurance fund adequacy. In addition, the FDIC's Chief Risk Officer will undertake a review of the FDIC supervision of Signature Bank and will also release a report by May 1. Further, the FDIC will issue in May a proposed rulemaking for the special assessment for public comment. The bank failures demonstrate the implications that banks with assets over $100 billion can have for financial stability. The prudential regulation of these institutions merits serious attention, particularly for capital, liquidity, and interest rate risk, and also the consideration of a long-term debt requirement to facilitate orderly resolution. Recent efforts to stabilize the banking system and stem potential contagion from these failures have ensured that depositors will continue to have access to their savings, that small businesses and other employers can continue to make payrolls, and that other banks, small, medium, and large, can continue to extend credit to borrowers and serve as a source of support. The FDIC continues to monitor developments and is prepared to use all of its authorities as needed. The FDIC is committed to working cooperatively with our counterparts at the other federal regulators, as well as with policymakers in the Congress, to better understand what brought these institutions to failure and what measures can be taken to prevent similar failures in the future. Mr. Chairman, that concludes my statement. I'd be glad to respond to questions.
Thank you. Undersecretary Lang.
Ranking Member Waters, members of the committee, thank you for inviting me to testify today and for the opportunity to speak several times in recent weeks to share updates from Treasury regarding current events. The American economy relies on a healthy—
If you'd pull your mic closer and, or direct it towards you. Thank you.
The American economy relies on a healthy and diverse banking system, one that includes large, small, and mid-sized banks, and provides for the financial needs of families, businesses, and local communities. Nearly 3 weeks ago, problems emerged at 2 banks with the potential for immediate and significant impacts on the broader banking system and the economy. The situation demanded a swift response. In the days that followed, the federal government took decisive actions to strengthen public confidence in the U.S. banking system and to protect the American economy. On March 9th, depositors of Silicon Valley Bank withdrew $42 billion in deposits in a period of just a few hours. After concluding that significant deposit withdrawals would continue the next day, the California state regulator closed SVB and appointed the FDIC as receiver. 2 days later, the New York financial regulator closed Signature Bank, which also had experienced a depositor run, and appointed the FDIC as receiver. Treasury worked to assess the effects of these failures on the broader banking system, consulting regularly with the Federal Reserve and FDIC. On Sunday evening, recognizing the urgency of reducing uncertainty for Monday morning, Treasury, the Federal Reserve, and the FDIC announced a number of actions to stem uninsured depositor runs and to prevent significant disruptions to households and businesses. First, the boards of the FDIC and the Federal Reserve recommended unanimously, and Secretary Yellen approved after consulting with the President, 2 actions that would enable the FDIC to complete its resolution of the 2 banks in a manner that fully protects all of their depositors. These actions ensured that businesses could continue to make payroll and that families could access their funds. Depositors were protected by the Deposit Insurance Fund. Equity holders and bondholders of the banks were not covered. Second, the Federal Reserve created the Bank Term Funding Program, a new facility to provide term funding to all insured depository institutions eligible for primary credit at the discount window, based on their holdings of Treasury and agency debt securities. This program, along with the pre-existing discount window, has helped banks to meet depositor demands and bolstered liquidity in the banking system. This 2-pronged, targeted approach was necessary to reassure depositors at all banks and to protect the U.S. banking system and economy. These actions have helped to stabilize deposits throughout the country and provided depositors with confidence that their funds were safe. In addition to these actions, on March 16th, 11 banks deposited $30 billion into First Republic Bank. The actions of these large and mid-sized banks represent a vote of confidence in the banking system and demonstrate the importance of banks of all sizes working to keep our economy strong. Moreover, on March 20th, the deposits in certain assets of Signature Bridge Bank were acquired from the FDIC, and on March 26th, the deposits in certain assets of Silicon Valley Bridge Bank were acquired from the FDIC. We continue to closely monitor developments across the banking and financial system and coordinate with federal and state regulators. As Secretary Yellen has said, we have used important tools to act quickly to prevent contagion, and they are tools we would use again to ensure that American deposits are safe. Looking forward, while we do not yet have all the details about the failures of the two banks, we do know that the recent developments are very different from those of the global financial crisis. Back then, many financial institutions came under stress because they held low credit quality assets. This was not at all the catalyst for the recent events. Our financial system is significantly stronger than it was 15 years ago. This is in large part due to the post-crisis reforms for stronger capital and liquidity. As you know, the Federal Reserve announced a review of the failure of SVB and the FDIC a review of Signature Bank. I fully support these reviews and look forward to learning more in order to inform any regulatory and supervisory responses. We must ensure that our bank regulatory policies and supervision are appropriate for the risks, old and new, that banks face today. Thank you to the committee for its leadership on these important issues and for inviting me here to testify today. I look forward to your questions.